right, welcome to the Big Skinny with me, Lou Basenese. We got a crowd here in our Brooklyn studios, and we hope we got a crowd forming online for what promises to be an exciting and informative and hopefully profitable show. We're talking about the ETF boom. We're talking about pick six lottery winnings, maybe. I don't know. You better stick around and find out what that's about. Also talking about the single most important factor for AI growth. Got an expert joining us that will give you some insights. But first, you're probably wondering if this is your first time or if you just had a long weekend and maybe imbibed too much and can't think straight. What's the Big Skinny all about? Well, it's pretty simple. The Urban Dictionary defines the Big Skinny as insider information. We are absolutely not that. But what we are, and also that definition goes on to say, it's the essential truths, the information that matters the most. And that is exactly what we're all about here. In a world that's inundated with information from multiple media platforms and email lists and your mom and your grandmom and your cousins at Thanksgiving asking, should I buy Bitcoin? Should I not buy Bitcoin? What about this Ethereum? What about Crapcoin? Yeah, we're here to sort through all that and tell you the only things you need to pay attention to in the market to increase your bottom line. Because at the end of the day, if we don't make money together, we're not going to be hanging out much longer together. So that's what we're here for. Along the way, we have a very straightforward way of sharing this information for you. We've been told we're the sports center of financial news, so kind of like a highlight reel. I'll take that. I like to think of us as Dave Portnoy for pizza reviews, but for investing news, because everyone knows Dave. One bite, everyone knows his rules. Well, we have a similar approach. Dave never takes just one bite. And we share our information in a few bites. In fact, it's more specifically one headline that you should ignore, one chart that shares the key data that you really should pay attention to, and most importantly, one investment insight that you should follow, the action to take, so that you can increase your bottom line, and we can too. So we do that each week, sharing three things that stand out the most to us in our rundown. Along the way, we invite you to join the conversation too. We're live streaming on multiple platforms. It's as simple as getting some keyboard courage and typey in there. Alex from Los Angeles is here. Alexander Castro, welcome to the show. We hope there's no connection to Fidel from Cuba. But hey, who knows? That could be a good thing. I don't know. Maybe this is a revolution we're having here online. But please, it's as easy as that. Alexander's not afraid to chime in. Please don't be either. Along the way, we're going to answer those questions. It's like a choose your own adventure. And we'll let you choose it. You can be pithy with your comments. You can be derogatory. We'll take them all. And just expect to get some heat back if you're not nice to us, right? So if you don't want nice things, well, I can't remember. My mom said something about being nice growing up. I'll try my best. But here's the other thing you need to know. I know that I don't know it all. In fact, part of our manifesto here is to be humble in the markets, or we're going to be humbled in the markets. And the way to be humble for us is to bring on guests that know way more than us, that can help us inform our opinions, inform our ideas, and our investment thesis. And today, I have not one, but two amazing guests to bring on. Daniel Turner from the Power of the Future Foundation. He's going to share with us some of the most critical factors about the AI race and the need for energy from a very unique perspective. This is a gentleman I've known for really, really long. About a week and a half, he reached out to me on social media, and I just was captivated by what he's doing. Really excited to share his insights with you. And then also after that, there's an ETF boom underway we'll talk about, and we're going to bring on John Tinsman, the founder of AOT Invest. One of the youngest, sharpest minds I've been around. Had the benefit of being at the New York Stock Exchange bell ringing ceremony with him for not his first, but his second ETF launch at the ripe old age of 31. Yeah, boy, do I feel old and unaccomplished. At 48, I have none of those things. But we're going to bring to you what matters. It's a big focus on innovation. So I'm really excited to share what John has to say with you. But with that being said, let's get to this week's rundown. All right, we're back, and in this week's rundown, we've got a few topics to cover, and the first is the ETF boom. If you haven't been paying attention lately, you may have missed it, but ETFs are popping off. A record $44 billion in the month of July went into actively managed ETFs. Now, if you don't know what active versus passive means, active ETFs are ones where there's actually someone behind the curtain, the Wizard of Oz, pulling the levers and picking the stocks. The passive ones, they're just the indexed ETFs. They're the ones that follow a very specific index, no changes along the way. You can trade the S&P 500, the NASDAQ, and all other subsectors automatically. But here's the thing, right? Active ETFs, 44 billion in inflows. If you incorporate all the passive ones, in the month of July, you had 123 billion in total inflows. That's a lot of money flowing into the market. So how do you make sense of it? Well, there's a couple strategists out there that are trying to explain what's going on. Todd Sohn from Strategist saying, look, it's clear issuers want to be where the growth is, and that's in active managed ETFs. But there's always a but, isn't there? There's many without either a proper solution. They just decided to launch an ETF and don't really know what the problem they're trying to solve, or they don't know where it fits, and without strong enough distribution to compete. And that's really the reality here. I'm focusing on this ETF boom because it's growing so rapidly and it's changing the complexion. If you look at the difference between money going into active versus passive ETFs right now, you can see that a flood of capital is now going into active ETFs. Over 37%, over 35% of new money is now going into active ETFs versus passive. You go back a decade ago, it was barely anything going into active ETFs. Now, let me be clear. It's a lot of money in the ETF market, about $11 trillion in total, and about 10% of that is in active ETFs. But there are just not dozens, not hundreds. There are literally thousands of active ETFs. In fact, 4,300 ETFs in existence, 51% of them are active. We are entering, there's not enough Spaceballs references in finance today. We're entering ludicrous mode. It's activated, folks. If you look at the blue line, it's truly gone exponential. John Candy, Spaceballs, active ETFs, here we go to the moon and beyond. Here's the key investment insight. With this many choices out there, with this much money flowing into ETFs, how in the world, as an investor, do you pick from a list of 4,300? Some of us struggle picking from a menu at a restaurant that has 7 choices. So we're here today to help you sort through that. In fact, we're going to start a segment where we feature compelling, innovative, active ETFs and their managers to help you sort through the stuff that doesn't matter and isolate the ones that could really improve and increase your bottom line. So the ETF boom's here. We're going to be with you hand in hand along the way to guide you through that boom. What about Pick 6? Well, what's this about? Pick 6 lottery in New York. I don't know what it is in the other states in the country, but it's I would say historically that lotteries are a tax on stupidity, right? Your odds of winning are terrible. They're worse than in the stock market. But guess what? There are some people out there that believe individual stock picking in the stock market is a stupid activity as well. Look at the Financial Post. Hard-earned truths. The pros can't pick stocks, and neither can you, lowly, Main Street, everyday American like Lou Basenese. But here's what I'm here to tell you. I spent 20 plus years in this industry, and I can tell you countless times over, it wasn't just luck that I picked stocks that did really well and outperformed the market. Am I some genius? No. I think I have a below average IQ, but an above average work ethic, and that's what matters when it comes to investing in the markets. Now, there's lots of schools of thought here, right? If you look at the founder of the Vanguard Group, that ETF juggernaut that really popularized really cheap ETFs, John Bogle here, he said, don't look for the needle in the haystack, just buy the haystack. Yes, that works. It's an easy way to make sure you're invested in the market and make money. But there are those needles or gems in the haystack that can make you a lot more money a lot quicker. So it's about diversification. Well, what about other people? What is their philosophy? Because we know some of the wealthiest investors in the world are not indexers, they're stock investors. This guy named George Soros, anyone, does that ring a bell? I'm not talking about politics here. Let's not get into that. But George Soros, in his own right, is a phenomenal investor. High conviction, high concentration into individual bets. I think the big one was he made $1 billion betting against the British pound one time overnight. Wouldn't we all love to make $1 billion overnight? But he says it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. We're going to talk about this analogy later. It's like baseball, right? Well, here's another one. Jeff Bezos, anyone who just threw probably the most expensive wedding in existence in Venice, given a 10% chance of 100 times payoff, you should take that bet every time. That's right. You have to go for what we call asymmetric return versus risk profiles. That means that the potential upside is dramatically larger than the downside. If I told you you could lose your money 10% of the time, but in that same instance of putting that money at risk of a 10% loss, you can make 100 or 1,000 times your money. Would you do it? Well, you should. And we're here to prove that you can. How? Well, look, we unveiled about 2 months ago, 62 days ago to be exact, our top 10 AI stocks not named NVIDIA list. You remember this here. Going down the list, Teradyne, Samsara, these were not companies that were on a lot of people's radars. So we told you, we're here to make money together, otherwise we won't be here together. So how are we doing? How are we stacking up? Well, we compiled the data after a mere 60 days or so, and we're doing all right. You be the judge, though. I mean, I'd love me some Yankees. If you're a Mets fan, Dan, get out of here. Nah, just kidding. All right, and Dave. We got 2 Mets fans in the stands here. We have to change that. Bleacher seats for the next episode. But you be the judge here. We've had 5 picks that are in the green and 5 picks that are in the red. But remember what George Soros said. It's not about how much money you lose. It's about how much you make when you're right. And we've been right more than we've been wrong. We're actually batting 500. We've had 2 stocks that have roughly doubled since we introduced them. So folks, this is proof positive that you, not being a pro, can have better than pro results in the stock market if you know where to look, if you know the people to follow and the research to follow. So we endeavor to keep doing that. That's the investment insight. If you've been waiting to buy the stocks that we selectively recommend here, what are you waiting for? The results, the proof is in the pudding there. In the AI trend, I believe it's still going to continue to grow from here, and all those stocks remain compelling buys at this current time. All right, now we talked about AI on the upside, but what about the downside? The AI crisis is making headlines for multiple reasons, right? The business media would love you to believe that this is a bubble that's about to pop imminently. Business Insider here with the words, the stock market's dangerous AI bet. Oh, wow, how foreboding. It's going to end ugly. I don't know what happens when they train journalists, if they just train them to be glass half empty or almost always empty. Why can't you just take the positive spin sometimes? Be measured, right? Because remember, flashback to January, Bloomberg this time was out saying traders say DeepSeek is a threat to pricey U.S. tech stocks. Well, guess what happened to those pricey U.S. tech stocks? Yeah, they cratered on Liberation Day in April, but they bounced back in a big way, and now we're at all-time highs. So what's the takeaway from AI? Here's what you need to know. This is one of, if not the biggest growth trends that you'll ever see in our lifetimes. But what we have here is a failure to communicate, if you ever watch Cool Hand Luke. People aren't communicating what is necessary for this trend to continue. Well, I should caveat that. Very few people are. We're trying to, and our first guest is going to help us articulate it, that the real AI crisis is not about valuations. It's about energy and access to energy to meet AI demand. If you look here at training AI models, every 5 months or so, you need double the computational power necessary to train them. But guess what? Every 1.4 years, you need double the amount of electricity to train these models. What does that mean? It means a stodgy old electricity industry, which really doesn't grow much more than 1 or 2% a year, is now looking at 10% growth between now and 2030. Now, this is not about just simply upgrading your equipment. It's not simply about renovating your house. It's about renovating your house and at the same time doubling the size of it. So it's a Herculean effort that needs to be undertaken here. So what's the key takeaway? Well, I hate to admit it, but the United States is sorely lagging. Look at China here, right? This chart shows you the amount of electricity demand that needs to be generated and what part of that needs to go to data centers. In the US, it's almost 50%. Between now and 2030, all the additional electricity demand, 50% of that is going to come roughly from data centers. China, they're at a manageable 8% because they've been managing their growth and they've been building electricity generation for the last decade plus, where we've been sitting idle, roughly just hovering around 4,500 terawatt hours of potential capacity. So this is the AI crisis in a nutshell. How do we solve it? All forms of energy. And we're going to get into that in more depth with our first guest. But don't forget to join the conversation. Chad Towers here jumping in with a tiny text. Let me see if I can read, or maybe it's just my old eyes. Love this stuff. Big day tomorrow, this afternoon with Prop. Yep, so we'll talk about Prop later. I can't. We're in a blackout. We report earnings tomorrow. That's my employer. Obviously, I love energy, and that's why I work for the company. Upcoming at Entercom in Denver. Hope to see you there, Chad. Question, is Toast a stock to hammer here in your opinion? Chad, I'm going to make you wait for the answer because I know our second guest knows toast very well too, better than me in fact. So stay tuned for that in our third block when we talk to John Tinsman. But before we get there, we're getting to Daniel Turner, and we want to make sure before that even that you're signed up for our newsletter at thebigskinny.com. You go to thebigskinny.com or scan the QR code on your screen where you can get our newsletter with one headline, one chart, and one investment site served up all the time. So with that, we got one thing to say, and then we'll take a brief break. Well, this is the time of the show where we advocate for various advertisers, but this one is near and dear to my heart. It's the NikaClinic.org. It's a 501(c) U.S.-based nonprofit that provides necessary and critical medical care, not in the United States, but in the second poorest country in Latin America. That's Nicaragua. Now, I say we because I've been fortunate enough to be involved with this organization for over 15 years and on their board for the last 4 to 5 years. So I've personally seen firsthand, along with my family, the work that they do in the community that directly impacts the health of a beautiful nation of people that, unfortunately, if you read the U.S. headlines, everyone would make you think that Nicaragua is a terrible place. It's a beautiful place, beautiful culture, beautiful people, but they don't have the things that we take for granted. So again, there are tons of charitable causes, non-charitable causes that compete for your time and your attention and your capital. By no means am I going to try and wrestle you with that, but I would encourage you, when you do have time, go to NikaClinic.org. Check out what we're doing in the community. And what I love about this organization is that you know that your money, any money that if you choose to donate, goes directly to making an impact, and it goes a long way. The last time we did a fundraiser, we were able to buy a second ambulance that opened up the opportunity to serve more than 30,000 people. Now think about that. A one-building medical facility the size that of some waiting rooms in emergency hospitals that we're used to here can serve 30,000 people. So please, if you have extra time, check out NikaClinic.org or scan the QR code on your screen, because I truly believe and know that working together, we can make a difference in those communities that need it. We'll be right back.
Palantir story of the morning, big quarter out of them. Results accelerated quarter over quarter. Your thoughts on what you saw at Palantir, and what does it mean for the broader AI trade?
Look, I think it's just more of the same of what we saw for the last 2 weeks out of the Mag 7 stocks. I mean, it's really gravity defying how much CapEx is going into AI, and Palantir is capitalizing on that. I mean, if you look at just Amazon, Alphabet, Microsoft, and Meta, they invested $82 or $88 billion in CapEx in the last quarter in just in AI and data infrastructure. And there's no signs of this stopping anytime soon. And I think, you know, everyone always first blush wants to react and say, hey, this spending can't continue. But the reality is that it is continuing. I think the real key bottleneck for AI now becomes energy, not necessarily chip availability. If you remember a couple quarters ago, we were talking about Blackwell's NVIDIA chips being available or not. Now it's really going to be, do we have the energy supply to fuel this runaway growth that all of these big tech companies are all too willing to invest in right now?
Well, Lou, do we have the energy? Because I look at these Palantir results, they have accelerated quarter over quarter, beat estimates, big guidance ahead. Can companies like Palantir get the energy they need to feed their results?
So I think you saw in the tie-up, eventually, yes, we're going to find a way to bridge that gap, but it's not immediately available. That's why you saw CoreWeave go out and acquire Core Scientific, because Core had guaranteed power contracts.
Welcome back to The Big Skinny with Lou Basenese, who's got a talking problem today. I'm a little bit behind schedule, and I hate to do that because I don't have all the insights. My next guest definitely has more insights than me when it comes to the energy landscape. And without further ado, I'd love to welcome Daniel Turner to the show. First time on The Big Skinny. Daniel, great to have you here with us, my friend.
Thank you. It's awesome to be here. I appreciate the opportunity.
Yeah. Now, listen, I want to cut right to the chase. I'm always a personal first guy, right? So how in the world did you get connected to the energy industry and the cause fighting for workers in the energy industry? Because your organization, Power of the Future, comes at it from that unique angle.
Yeah, thank you. No, I started the organization 7 years ago for the sole purpose of fighting for American energy workers. There was this war on American energy, and the people who make energy policy, like me, they come from New York City, even though I don't live in New York anymore. I live
Hold on, Yankees or Mets fan? We got to settle this real quick.
100%.
All right, we can continue, folks. Yeah. At least we got the real smart person on there. Unlike
now I live on a farm in rural Virginia, but my roots are in New York, and it's New Yorkers that make energy policy. It's Washingtonians, right? It's people in San Francisco. But our energy workers are found in rural America, and so energy workers never had a seat at the table. So I wanted to start an organization to advocate for them, but also start an organization where I couldn't be canceled, right? I mean, when you talk energy, you're talking about a lot of sensitive subjects, obviously the economy, but also international affairs and politics. And I needed to say things that have to be said without fear of someone canceling me or, threatening to boycott my product or shut down my company.
Well, and the crazy thing is, you're talking about saying things that are actually facts, but they didn't want the facts out there, right? I mean, I think you
exactly.
and I were... Go ahead.
And this area is just one more example of it, right? This is going to be an uncomfortable conversation on AI and energy, but it's not because I hate any of these subjects. It's because the truth needs to be said.
Yeah. I mean, it's uncomfortable now. I think it's starting to come into the news, right? You shared with me a New York Post article about electricity bills in New Jersey going up. If you look around the financial media today, Zero Hedge is tweeting out about tomorrow's CPI print, and they're paying attention to electricity prices. There's a real choice being made now between consumers and computers, right? How do you see this playing out from your side of the perspective, understanding that you have intimate knowledge of the industry from the ground up, literally from the workers? Where do you see this reconciling?
My biggest concern about AI is when it comes to energy consumption is that we've never been in this sort of exponential leap in energy consumption before. So if you go back to, the beginning of the tech revolution, the 90s, people are likening it to that, right? When there was this internet revolution, well, didn't we all start buying computers and didn't we start building some data centers? And the answer is, yeah, we did. But also in the 90s, we started this massive offshoring, right? We started outsourcing jobs. We started closing down all of our factories in the Rust Belt. And that's another conversation to have. But our energy consumption as the nation kind of stayed pretty much equal, right? As we were shutting down a steel plant in Pittsburgh, we were building a data center in Pittsburgh, and it was kind of a wash. But what we're doing now is we are using energy so much more, and we need so much more of it, but we are not producing. And supply and demand laws dictate, right? Prices are just going to continue to go up exponentially until we start producing more.
Yeah, and look, this is the thing that I love about this conversation is it's not an argument. It's simple economics at work, right? You said it. It's supply and demand. It's not that Lou and Daniel have an opinion that energy and fossil fuels should be used to provide that energy. It's the fact of just a reality. I mean, if you look at data center energy demand, we're showing it on the screen, it's supposed to double in 5 years. This is just coming out today from Apollo's Torsten Slok. Where do you see the problems, right? Like, obviously, one problem, huge problem, was resolved. We had a change in the administration and their political leanings, right? The big, beautiful bill eliminated a lot of subsidies, not all. But where do you see the solutions coming, and how quick can they come from your vantage point? Because I think, in my mind, that's it's not can they come, but it's can they come fast enough?
Yeah, we recommended to the administration. I was in the White House a couple weeks ago walking the Energy Dominance Council through this. We just outlined there's close to 100 electricity producing plants that have been slated to be shut down by the previous administration that are currently offline. You can put them back online, right? That's a pretty easy and quick fix. And some of them are well known, right? Indian Point Nuclear in New York, Diablo Canyon Nuclear in California, right? These are facilities that still exist. They just have to be put back online because that base load power is the real fear. When I talked to high school kids last week, and this question came up, and high school is a little difficult to understand these kind of larger principles, but I used this example which worked. If you live in suburbia, which a lot of these high school kids did, and I said there used to be this big field, right? It was a farm. It was Grandpa's farm. And then the county gave permission, and they came in and they built 500 houses. And everyone's like, oh, look, they're building houses in that community. But you know what they didn't do is they didn't do anything about the road. And now all of a sudden, this little tiny road in a small town has bumper-to-bumper traffic. And all the locals are scratching their heads saying, what the hell happened? Like, how is this possible?
Right.
Like, everyone is enthusiastic about building 500 houses, but no one is enthusiastic about widening the road or putting in a roundabout or an intersection. And that's what we're doing.
Roundabout, hold on. People that aren't from New Jersey have no clue what a roundabout is. You can't make a U-turn in New Jersey, which is probably the most insane, stupid thing I've ever seen. But anyway, I digress. But I like that that analogy. So for those who don't know, a roundabout is you literally have to make a right turn to get off the highway to turn back around and make a left turn to turn around. But I love that analogy because I guess, so from your standpoint, like the numbers that you see, how much money needs to be invested to properly upgrade, widen the roads, the electric roads, if you will, to provide the capacity that we need?
Well, I mean, the number is almost hard to quantify, but Morgan Stanley put out a report that said by the year 2030, we will need enough electricity to power AI as the entire Iberian Peninsula. Right? That's Portugal and Spain.
Wow.
And that's just to power artificial intelligence, not to run the AC in your house or power New York City or power Yankee Stadium. Lights can go out in Shea, right? But the rest of us, that much electricity just to power these data centers. And I use that analogy of building in the community because I think there's a lot of enthusiasm to bring in data centers. They don't add to traffic, right? You build these huge facilities. Once construction is done, in theory, they just generate revenue because the company is paying rent and paying the county, paying the state. But they are huge power sucks. Your average data center is the equivalent of 100,000 homes. So here in glorious Virginia, where I live, Glenn Youngkin, huge proponent of data centers. A third of America's data centers are on my drive from rural Virginia to Washington, D.C.
So wild. No one would ever think that, but that is God's honest
where they're
truth.
all located. And they've all been built in the last couple of years. So I tell people in Virginia, we've added the equivalent of 23 million residents in terms of consumption of electricity. We haven't added 23 million in terms of car, in terms of food, in terms of sewage, but electricity, 23 million people is a huge growth of population, but we haven't increased our electricity production really. So what happens? We're all paying 40% more for electricity. And people say, wow, this is crazy. That's what's good. That's what's happening.
And I think that's right. I think that's the wake up moment, right? When you see your electricity bill go up and you go, wait a minute, nothing's changed. I didn't change my consumption from last year. If I look, you get your bills from Con Ed and it shows you what was your consumption last June and July, and you can see this. And if it doesn't change, but your bill goes up, I think that's where the rubber's going to meet the road. Or when, God forbid your power goes out because it had to be reallocated for data centers. So where do you think there's a danger that the public outcry over inflationary electricity costs drowns out the logic of and the need for all forms of energy to provide power, right? I mean,
100%.
Yeah. How do we overcome that? Because I would say that one party's done a really good job at marketing. The other party's done a really terrible job at marketing and informing. And you talk about going into the high schools and informing the youth. I think we need to be out doing that on all things, not just politics, but investing. But how do you bridge that gap, the information gap, outside of everyone joining your organization? What are the other effective tools that people can use?
I think people need to see why it's a benefit for the community. And right now they necessarily haven't seen that. The increased revenue for the county hasn't translated into lower property taxes, or, they always fudge these numbers. There's more money for schools, but what parent has ever seen their kid's education be better because they built a data center down the road, right? So there isn't that translation as to why it's better for the community. I think where the opportunity lies is that data centers don't have to be in urban areas. They don't have to be in suburban areas. They can be anywhere, and we should be putting them where the electricity is. So the governor of Alaska, for example, is making a big push to move data centers there, because once it's built, what do you care if it's 40 below zero, right? If they're running, they have all the coal, they have all the natural gas, they have plenty of water, they have plenty of land. So why isn't Microsoft building all of its data centers in the middle of nowhere in the tundra, or the Permian Basin in New Mexico, Texas border?
Oh, yeah.
Right. One of the biggest problems with the natural gas boom there is that there isn't enough pipeline infrastructure to actually get the gas out. So they're burning it because it's cheaper than storing it. Why aren't we building data centers in the desert in the Permian Basin of New Mexico?
Well, it makes perfect sense because I agree with that, because we're in Colorado Prairie that my employer works for. We're in Colorado where Colorado you're not allowed to flare any gas at all. So everything has to be connected to pipe, so you don't have that issue, right? The gas gets captured. But you're right, in the Permian, and this answers an environmentalist's biggest cry, right? You're polluting the air by flaring natural gas. Okay, well then let us use that clean energy to power a data center and co-locate it. There's nothing else really in Midland, Texas, apparently, from what I've been told. So.
I mean, this is where there is tremendous opportunity in the data center world, and in terms of AI. You know, I look at AI and I think of that quote from Paul Krugman, which I know he wishes he could walk back. But that famous quote where he talked about the internet, and he said it's really not going to have any impact on the economy. And it's easy to laugh at him for multiple reasons, right? I don't think anyone would make that quote now about AI, but anyone who says like, oh, I know what AI is going to do is kidding themselves. Because we had no idea when the internet came out and we all saw it as kids. We had no idea what the internet was going to do.
Yeah, listen, I'll give you a recent example. I saw it today right before we came online. Grok 4, the latest version of AI out of XAI, and X actually got itself suspended on X, its own account, and then it got downgraded. So it's just, AI doesn't even know what it's going to do. But I think you're right that we can't, it's impossible for us to put it into tangible terms, how much electricity it's going to require, the tasks that it's going to complete that are necessary to everyday life. I think you tried to help inform people on that, and you correct me if I'm wrong, but you've got a free report at your website that I want to make sure people check out. We're going to put a QR code on the screen for you to download. It's called Rocket Fuel for America's AI Moonshot 2025. Give us a teaser. What's in this report that's really important for people to understand?
Thank you. We can send you hard copies too if people want it. But I brought it to almost every member of Capitol Hill. I brought it all throughout the White House, and we are trying to get our elected officials to take this seriously. And we likened it to the moonshot because we go back to this period of American history when everyone was pulling together, right? That people told that famous story that when JFK walked through Houston and asked people what they did, they didn't say, I'm a janitor, or they were like, I'm putting a man on the moon, right? Everyone had this idea that we were working together and everything was on the table, all options, all scenarios. And that's what we're kind of calling for with AI when it comes to electricity, because if we forego this opportunity, other countries want it. And if China dominates the AI race, that's bad for the world, just flat out, right? And even other countries that aren't as hostile as China, I just don't want them dominating AI. I don't want the Saudis dominating AI. I don't want, I can list a whole host of countries. I want America to dominate this world the way we've dominated the space race, the way we've dominated the internet revolution as well. So we put out this study that just lists all the challenges, how much electricity we need to produce, where we're going as a country. We offer a lot of solutions, but we did it in terms that your average Capitol Hill staffer can understand, right? I mean, we need our policymakers to read this and understand it and synthesize it and turn it into policy prescriptions. And that's where we're kind of hitting some challenges. And if we lose this, we lose a huge opportunity. So there's a lot on the line.
No, well, look, I appreciate the work that you're doing. I appreciate the vocal voice that you are. And from people, I want people to hear this from your description of what you are and why you exist. With so many loud voices in the energy conversation, ours will highlight truth, unmask agendas, expose hypocrisy, and reduce hyperbole. So you're getting to the facts, and that's what we're all about here, the Big Skinny. So I encourage everyone to go to powerthefuture.com, download your free copy of this report, and more importantly, go follow Daniel and his company and his organization so that you can be empowered with the truth on this AI energy crisis that I'm telling you and that I've been advocating is the biggest unknown problem that is getting exposed finally. But you got to stay informed because it's going to inform your investing from here on out. Daniel, I'd love to have you back as this situation unfolds, but thank you again for your time.
Anytime. Thanks, Lou. Great to be with you.
You too. Go Yanks.
Yes.
Take care. Listen, folks, always free resources here. Oh my goodness, playing the songs. Let's take me out to the ballpark, please. Listen, I encourage you. We always want to share information that can be helpful. There's nothing in it for us except informing you, and making you more informed makes you a better investor. So please go to powerthefuture.com, and after that, stop at thebigskinny.com where you can sign up for our newsletter or scan the QR code on your screen. We'll be right back after another brief word. Attention investors, are you looking for a high growth opportunity in the energy sector? Well, look no further than Prairie Operating Co., trading on NASDAQ under the ticker PROP. As America's premier high-growth, low-cost oil producer, Prairie Operating is making waves in the DJ Basin, which is in northern Colorado. With their recent transformative acquisition, they've expanded their footprint to 55,000 net acres and increased daily production by over 25,000 barrels of oil equivalent. Prairie is poised for strong growth, maintaining a strong balance sheet while delivering value to shareholders. Don't miss out on this exciting investment opportunity. Prairie Operating Co., PROP on NASDAQ. A few disclaimers. I've mentioned it already that I work for Prairie, so I'm deeply conflicted. Also, past performance does not guarantee future results, so consult your financial advisor before investing, and be aware, Prairie's actually reporting earnings after tomorrow's bell, so it's always a volatile time around stock earnings. So again, do your research and then make up your mind on what to invest in. We'll be right back.
Wildly from month to month. That's no way to run a country.
That's where I want to land this plane, because I think you're right. You're giving me hope that there is a solution. We can integrate, right? We can have these systems start talking to each other to give us more reliable data. But as an investor, I have to step back and say, if there's a lot of noise, there's still got to be some signal there. And so in an individual report, it's not worth much to me. But if I look at the trends, they're very troubling. If you look at the non-farm payroll data from January, the 3-month rolling average was about 220,000 ads. In the last report, we're down to 35,000 ads. So that's a tremendous cooling in the labor market. Meanwhile, Powell comes out on Wednesday and says the labor market looks solid. And then Fed President Williams comes out on Friday after that data and says, oh, it's really just a gradual cooling. When I look at the trend line, it's not a gradual cooling, it's happening, and this is what's got to motivate the Fed. I've been in the camp that they shouldn't cut. I'm now firmly in the camp of they absolutely cut. Is it 25 or 50 basis points in September? I don't know where you land on it now.
So here's part of the problem, though. The data that we're talking about that's really coming down pretty quick, that the rapid cooling you're talking about, that's the non-farm payroll number, but the Fed is not focused on that. They're really focused on that unemployment rate. Now, I'm not saying they should or shouldn't be one or the other, but that's what they keep talking about. Full employment to them does not equal job growth. It just equals a low unemployment rate. So as long as that stays relatively low, we might be overestimating the odds of a cut this year.
Welcome back to The Big Skinny with Lou Basenese, and I'm still Lou Basenese, your host with most of the information, but I'm going to bring in a guest here shortly after we answer a quick question that has a lot more information for you on innovation, ETFs, and technology. But Chad jumping in the conversation again, saying he's all ears to learn more about ETFs. He's pretty strong in Hack, which is the cybersecurity. IYH, I don't know it offhand. XLE is the energy one. Love me some energy, trading at about 15 times earnings, that sector. So he wants to grab more. And you know what, Chad? Thank you for setting this up so perfectly for a conversation with John Tinsman, because I'm going to tell you what he won't tell you. It's one of the best performing ETFs this year and going back since its track record and founding. It's the AOT Invest Innovation and Growth ETF. Without further ado, I'd love to welcome John Tinsman to the show, the founder and the young stud behind all the success, man. Good to have you, my friend.
Yo, Lou, I I could hear you before. Can you try talking?
Can you hear me now?
All right.
All right.
Somebody tell me.
We're back.
Look,
you're so young and successful. We try and want to make you stumble and make it harder for you. Like, we're just going to cut off audio so you can't answer questions. But I was giving you an intro just saying how well that your ETF has performed. So why don't you tell everyone about the AOTG ETF? What's its foundation? What's the overarching principle? And then I'm going to kind of pick apart some of the picks and just riff with you on how they make it in the portfolio, and we'll talk through it from that standpoint.
Great. Well, you know, it's an honor to be here with you today. It's good to see you again. So if we keep doing this, we're going to end up being best friends, because I see you like all the time now. But
let's do it.
I mean, what I did was I looked back at like all of the history of investments, and I realized that growth was outperforming, value and core. That large cap was outperforming, the other caps by, pretty significantly. Maybe you've seen that like Morningstar chart.
Yeah, much to my chagrin, because I'm a small cap guy. But you're right. I'll give credit where it's due. Large caps crushed small caps lately.
Technology was beating everything else, and so I was like, well, like if you want to have a successful fund, it sounds like it needs to be a large cap, growth technology fund, and that's exactly right. Those are the very best funds in the whole market. But then there was a question of, I was buying other stocks that were doing really well that didn't fit into this category, right? So in this category, there were included companies like Visa and Google and Amazon, and none of these are considered to be technology companies. They're considered to, like, they're in different sectors. So
Right.
I was like, well, there's got to be a better way to include these companies to increase diversification and actually also raise returns. So I started calling it low marginal cost, and low marginal cost is like the cost that takes to produce one additional unit. So basically, companies like Visa, it doesn't cost them anything if you swipe your credit card one more time. They just make an additional fee. And that fee, it usually converts to a really high profit margin, which is good for investors. The cost to grow in these companies is actually free, basically, because all it costs is for the demand to be there. So basically, they can grow without debt, unlike other companies, like say like a fertilizer company would have to build more factories, and
Right.
airplane company like Boeing would have to build more factories. The growth is very expensive. A lot of times, the growth comes at lower profit margins. This is the exact opposite. The growth is not funded by debt, which is not risky, and it comes at very high profit margins. And then, so basically, like, the other thing about low marginal cost investing is it doesn't matter if the extra growth comes at 100% profit margins if the company's not growing, right? So if the company's like not growing at all, you're like, well, it doesn't matter then. So you need the growing companies like AMD and Nvidia and Google and Microsoft, but smaller large cap tech companies still like Toast and Robinhood. And if you have a portfolio like that, statistically, like in the past, you've crushed the indexes for a very long time.
And like, I love this for a few reasons. One, you isolated 3 or 4 key factors to outperformance, right? It's large cap versus, not small cap, right? It's growth versus core or value. Profitable was also one of your requirements, right? Which is, in tech space, there's a lot of fast growing software companies that aren't profitable. So you weed those out. And then low marginal cost. But then more importantly, the back test worked, but now so is the forward test. When you launch this ETF, talk to me about the performance, and then let's get into portfolio so people can really understand the names and the types of companies that are chock full in this ETF. So how's the fund done? I mean, the ETF done?
So the fund, I think the last I checked, it started trading in the 24s, and it was in like the 52s and 51s today. So it's up 100, over 110%. I think it's coming up on 120%. And at the same time, like the S&P 500 is up 60 something %. So there is like a pretty big spread there. It's done a lot better. The interesting thing is that it's continuing to do very well, and the profitability in these companies, I think, is really what's driving it. So like you mentioned, like not having unprofitable companies, and that's really true. Like when you think about like the .com bubble, right? You think about the NASDAQ like imploding, and like we know the NASDAQ has done better than the S&P 500 by a lot. I think it's like 500 percentage points. Yeah, that's since 2022 in inception. So it started in June 2022. You know what I find is so interesting?
Yeah,
like,
tell everyone what we're looking at here, because some people listen to the podcast, other people are going blind like me, but explain what you've put together, because I think this is a really powerful chart.
Yeah, this chart says that AOTG's rates up 117%, and we're going to start with the other things that aren't AOTG in this chart, right? So the Dow Jones Index, we know this is the index that has the lowest amount of tech exposure. It is up, and by the way, low marginal cost exposure also. So what I found in my research is that low marginal cost exposure is actually very strongly correlated with performance, right? So the Dow Jones has the least of it. It's the lowest, 43% over the last 3 years in like 1 month. All right, then you've got the SPX, the S&P 500. That's up 68%. So then the NASDAQ comes after that. It has a higher proportion of low marginal costs, tech and technology companies. So you can see actually the NASDAQ has beat the S&P 500. And then you can see there's the leading innovation ETF, which is ARK, which actually has a lot of unprofitable companies, which in my research actually doesn't raise performance, which I think is just really interesting, because a lot of times people
Kathy Wood is a great marketing machine, but I don't know that her stock selection strategy is as great as the marketing prowess.
Well, the problem is like when you're trying to pick all these like Kathy Wood, right? It's like, well, I've got CRISPR, it's going to cure all these genes, and then I've got this one, it's going to cure cancer, but none of them have actually done it. And so there's been a long.
It's the problem of being early is you look like you're wrong for a long time. But what you've done is you short-circuited that whole pitfall by just going right to successful companies, growing revenues, growing earnings, are already profitable.
Yeah, the companies are already doing it. And like a lot of people would be like, well, like, why wouldn't you just buy an index if you want a growing fund? And so I had the VUG, it's the growth index. It's done, better than that one also. And like my research showed it doesn't make sense to only weight by market cap. right? So like market cap it's a good thing to have a factor in, but once you're already in large cap, like, and you're not having a bunch of small cap or mid cap companies, like that reason to weight by market cap becomes a lot less compelling. And
Right.
it becomes a lot more compelling to weight by earnings growth, right? So like if you were to look at a company like Robinhood, it's growing its earnings at 150%, or Toast, which is another top holding, growing its earnings at like 100 and something percent year over year. You'd be like, well, I hope those have really big weights in like the growth index, right?
Yeah.
Whether it's like the Vanguard one or the things. And you're like, no, that's like a 0.2% weight in those. And you're like, wait, what? Like, well, what has the biggest weight? And they're like, well, Apple. And you're like, but Apple's not growing at all. Like, it's hardly growing faster than inflation.
I know.
And they're like,
You're going to
yeah.
dog on Apple,
Like,
but you're not wrong. It's one of my favorite stocks. I'm an unashamed Apple fanboy. But what you're talking about is weighting towards earnings growth. And I've always said earnings ultimately drive share prices, right? If earnings keep growing. So it makes sense that if you focus most heavily and heavily invest in the fastest earnings growing companies, the stock prices are going to go up the most. And that's what you're seeing in the ETF. Is that not right?
Yeah, and I think the biggest reason for that, Lou, like, because a lot of people like to talk about an efficient market, but like we all know, like if like you invest in penny stocks, you don't get like a higher return for like your investment, right? Like, so it's kind of like a little bit baloney. But like I think what we're seeing is that people can't, analysts can't expect the upside potential in tech, right? So like people are like, oh, NVIDIA is up a lot, like, and it's doing well, but like, what do we think it's going to earn more in 2 years? And they're like, well, we know the GPU demand is crazy, but we can't put 18x. So let's just put 1x. They'll earn double.
Yes.
But they earned 18x. 2 years ago, they were earning 18 times less. Isn't that crazy?
No,
so
but
it's
that's
like,
the thing too. Like nowadays, the argument is like, well, the tech sector accounts and tech companies, the 10 biggest companies account for 38% of the S&P 500. It's never been this big, but if you look at the percentage of profit growth that they account for and how big the profit growth has been, it justifies it. And then if you look back at the dot-com days, like you were saying, there was a lot of unprofitable companies that ran up to stupid valuations. Now we have reasonable or more reasonable valuations and a lot more profits. So you're harvesting that phenomenon in the fund.
Yeah.
How do you rotate in and out? Like is it quarterly rebalancing? What are your selection criteria to swap out of a name? How do you manage the portfolio? Because we talked about this being an active versus passively managed one.
Yeah, well, the nice thing about like the active versus passive is it gives you like a little bit of flexibility. So like when you think about a company like AMD, right? Like we saw last year, they really weren't growing a lot. But if you looked at the earnings, you could see that their GPU business had crazy growth, like 50 or 60%, while the CPU business was shrinking. So you could see like in 1 year, like the GPU business will continue to grow and the CPU decline will top off. So it gives you some flexibility to have big weights in what you can see like clearly is coming a very strong revenue like acceleration. Now the way AOTG does rebalances is it does it quarterly, and a lot of that rebalance actually like over the last 3 years, like there's a lot of companies doing really well. So basically a part of that rebalance is actually diversifying. So basically like as a SEC diversified fund, I can only have 5% plus positions, total 25% of the fund. And then I also can't be 25% or more in any subsector. So like say semiconductors. So a lot of that is actually taking risk off the table, putting it into that next area of growth, right? And
so it's a tactical forced rebalancing, right?
And then the other part of that, is the company is like, what has stopped growing and what do you get out? Because you're trying to focus on the growing companies.
And then, so talk to me about the largest positions in video. What's the second largest that people, let's talk about second largest, why, and then what's the most recent addition to the fund?
Yeah, so Robinhood is the second largest, right? So the reason there is that they continue to provide a lot of value to people, like in a way that I haven't seen, right? Like they could have counted themselves down and out after the GME thing, but their CEO Vlad is a big innovator. I love those people like that, just including like Elon Musk, that they don't allow themselves to get knocked down without getting back up and keep going, right? So that's like a good thing to see. What they're doing, tokenizing stocks and breaking down barriers to cross-border investments, I think is like very, very bullish. And I like the next quarter, we're going to start seeing like some of the results of that from their European numbers. So I think that like basically they're a company that's a software company, even though they're in financial services. But what they do is they automate brokerage services, right?
Yes.
So basically what they're doing is that they're trying to make it very, very cheap by automating everything and passing that savings on. And what's crazy is like my neighbor's using Robinhood, but then like I watched the All In podcast and like all of the All In podcast billionaires are like holding up their Robinhood like gold cards. So it's like clearly like it's kind of like like breaking down barriers across demographics also to attract a lot of unique different people. And that means that like everybody's finding value in it, which I think is a good thing. The international expansion, look, if we know anything about American software companies, it's that they build it in the US and then they sell it at the rest of the world at 100% profit margins and blow everybody away by like how much they grow and how profitable they are. So
yeah, no, it's just the natural expansion. And then I think it's funny too, like they totally catalyzed the change in the brokerage industry across the old guard, right? You had to go to commission-free trades across because they led with it. And now the retail army of investors is so big and powerful that the other brokerages had to have a part of it. We did have one viewer ask about Toast. What do you think about Toast right now? We've all seen it, interacted with it. Some people might think the market's saturated. How would you respond to that? Phenomenal growth, but where does it go from here?
They have like no international locations. They're in like a couple countries barely, and like they just started. And like everywhere you go, basically, like in restaurants, like in New York or like where you are, like everybody has Toast. And you're like, well, why do you use it? Well, it saves them on payment processing fees. It does like, hey, your reservation's ready, right? And then it staffs their people at the right times. So it's like a comprehensive payment processing and software solution for restaurant businesses, right? So the first thing I think they do is they take that across the rest of the world, right? And they just start making a lot of money doing that because they're already profitable. And I think their profitability is going to expand a lot of these companies to reach 50 and 60% profit margins like we see in a company like Microsoft. The next thing I think that they're going to do is like, look, you have all these payment terminals, you have all this software to run them, you make your own hardware, right? So you're doing everything. Like, what's to stop you from like doing it for stores also?
Yeah,
you know what I mean?
Yeah.
Like they're already making websites for online ordering. Like, why don't you just go ahead and take on like Shopify while you're at it? So like, I see that like, look, I think like there's companies like Amazon, like they're a bookstore and then they become e-commerce and then they're like, well, we're going to do web services now. Yep. And it's like Toast has the potential to grow like that also. Like, and they have the potential to do it while making tons of money like they already are. So like, there's not a lot of risk.
It's low marginal cost for the next customer, but also low marginal cost to expand into an adjacent market opportunity as well for them.
That's the biggest thing about low marginal cost, right? So like every dollar you reinvest in business, you always make it better, right? So like when a traditional person like Boeing, they make an airplane, every dollar they put back into the business, they have to build another airplane. And that costs 99% of revenue, right?
That's right.
So it's like they can't, so like these companies like Toast or Microsoft can innovate at 50 to 100 times the speed. And they do. Like we've looked back 40 years ago, like, Boeing was making an airplane, ExxonMobil had a barrel of oil, and think about what Apple and Microsoft have done. And the question is, there's going to be like large cap companies that become like the future Salesforces also that kind of create this new market. I think Toast has the potential to be one of them, and I think Robinhood does too. And I think these are very exciting positions to have.
Well, listen, man, it's exciting to have you on. Chad Towers was just giving you the congratulations on your continued success. I want to echo the same thing. You've put together a very compelling strategy. It's not even just a strategy now. The performance is showing that it works. So I encourage people to check out your ETF, AOTG. You can go to AOTinvest.com, scan the QR code on your screen. And this, I think, is one of the perfect representations of how active management in the ETF space is leading to some really innovative solutions where the performance is delivering. So, John, I want to thank you for being a pioneer in this space. I want to thank you for welcoming to share the New York Stock Exchange with you and your family, that experience. And man, I'd love to welcome you back to the show as we talk about your performance another 6 months, 12 months out from now, kicking butt like it has been so far.
Man, thank you for having me. This is a great show. I love all the educational content you put out to try to leave everybody better off. So it's an honor to be a part of it.
Well, we'll see you again soon, my friend.
See ya.
All right. Well, hey, folks, don't forget to join the conversation. We're live on all the socials, and I want to cut right to forget a break before we go into the next block. We're just going in to bring the Dodd Man in to cover our high five and any other questions you have so we don't run out of time on those things. So without further ado, we got to welcome the man, the myth, the legend, Mr. Dodd. All right, there he is. Look, you got a TV screen with us on behind you, and you know what's funny? My flame's in the wrong spot, and I know you noticed.
Dude, what's going on over there? Place is falling apart.
We're upside down. Without you here, we don't even know. Like, Rome is burning. It's happening right now.
Yeah, I got a major storm happening here, so you might hear some heavy lightning or thunderbolts and lightning bolts going on.
If you weren't a UCF fan, you would have been shielded from the storm, right? It doesn't rain on UF fans. Sorry, brother.
you're just way too good. See, that's the problem right there. You think you're better than everybody.
Listen, before
That's
we get to the
problem.
high five, my wife had a request, right, for a new segment where at this time you dive in and you explain some of the things that might not, or you help or question, say like, hey, that didn't totally make sense what that guest was saying. How do we put it in layman's terms? But get this, she wants to call it the skinny dip. So I'm not really sure what my wife is advocating here. I'm going to get in trouble for saying this out loud, but yeah. So maybe next week, the skinny dip. Yeah, it is one that you'd come up with. So sorry, honey, I don't think we're going to skinny dip here.
With your wife and do some brainstorming. I like it. Yeah. I like the thinking.
Let's get to the high five before this gets off the rails anymore.
Yeah.
All right, we're back with the shenanigans. This is my favorite time of the show because we get to relax a little bit more and review what we did right or wrong. So what do we? And it's usually when I usually forget things and repeat myself.
Do you think you got them all today?
I got them.
You
all
think
today,
you got all these?
No, probably.
All right,
but we'll try.
Let's see. Too Big Tech is either a TikTok rap group that our kids are probably listening to, or the fact that tech is ruling the S&P 500.
Yeah, instead of Tupac, it's Too Big Tech. I like that. Let's see. Someone will run with that. No,
Could be a good rap group right there. That could be you and I. Maybe we have to start a rap group, Lou.
I don't think two white guys that aren't Jewish called the Beastie Boys could pull it off, but we'll give it a shot.
Hey, Eminem did it. So
it'd be the quickest path to failure I've ever had in my career, but yeah, let's go, man. Skinny dip and Lou and Dodd rapping. No, it's big tech talking about the current sector weightings, how it's just so large and therefore it shouldn't account for this, and therefore it should, tech stocks should sell off, and therefore you're going to get your life savings obliterated. Like the warnings in the headlines about big tech are just getting overdone. Yes, big tech accounts for roughly the amount of profits that they're generating. So again, it's all right-sized. It's all right. I wouldn't fight it. I would rather it be overvalued and overstretched and making us richer than us sitting here for another 2-3 years bemoaning the fact that tech's so overvalued and it keeps growing and we're sitting on the sidelines not making money. So I think that's the danger of scrolling too much in the financial headlines is you scare yourselves out of stocks. Don't do that. Especially big tech.
I won't do that, Lou. Thanks. That's great. Weight Watchers. I know you've been working on your fitness plan, but I think try intermittent fasting. It's a lot cheaper.
I can't. I'm Italian. I like to eat too much. That's the problem. So that's why I may resort to Manjaro or Ozempic. No, listen. I am sharing here, like I've said that GLP-1s, these drugs, which the class of drugs that they are just growing off the charts. They have downstream health effects that are really effective. And in this last quarter, I've always said that Eli Lilly would outperform Novo Nordisk. So Manjaro would outperform Ozempic because of the scientific composition of Eli Lilly's drug. And you're seeing it for the first time. Lilly's drug outsold Novo Nordisk this year. So I think this is a stock that both of them have gotten beaten up. There's a lot of people talking about buying the dip in Novo Nordisk. Nope, buy the dip in Eli Lilly. Yes, full disclaimer, own it and have been buying more. And I think it's going to be the best performer out of these two. So if you got to pick one horse in this 2-horse race, pick that one.
Well, there's a skinny on that, isn't it?
Yeah, it is. It's not the skinny dip, though, but it's the big skinny.
Yeah. All right, technical problems. No clue what this is, but I'm sure AI or a humanoid robot can fix it. So.
No, listen, this is my rant against technical trading indicators, right? I'm a fundamentals first guy. Tell me what the business is doing. I'll tell you where the stock's going to go. But there are people that are purists and chartists that just say, show me the chart and I can tell you what's going to happen. But guess what? Here's the same chart with two different technical indicator approaches overlaid on it telling you exactly the opposite thing. So it's the same data, and one technical pattern says that this stock, the S&P 500, is going to go rallying from here and rip through resistance. The other one says it's going to dive and break through support. So, yeah, I just don't put much faith in technical indicators. So sue me. I know we got a lot of traders that watch us, but I look at them. I think they're relevant. I just don't think they're the gospel when you're looking at it. You got to pay attention to the business more than you do the technicals.
I'm going to hope for a rally.
Yeah, I'm rooting for a rally too.
All right,
scary similar rally. The 2009 bull market that kicked off that went on for a long time in the blue line here looks exactly like the current rally that we're under, right? That had that little mini bear market in the middle. From this chart to the markets, let's hope this continues where this red line matches that blue line trajectory, because that means a lot more making money in the years ahead, Dodd, and that means the big skinny can still exist, 2, 3, 4 years out from here. So
let's hope so, man.
I know
like
you just got promoted. You're not an intern anymore, so we got to make sure you got longevity.
Still waiting to feel the fruits of that labor, but you know.
Well, here it is.
maybe
Beer me.
someday.
That's it. That's the fruits of
beer
the
me.
labor.
Well, I came prepared for that. I said, don't mind if I do. You got one of those there?
I don't have one. We're empty-handed today. We got to restock the studio here. But this beer me I remember this one because it's not often that I like to take a victory lap, but I will say that this is one of those times where everyone was screaming in June of 2023, right? So over 2 years ago, that a recession was imminent. And I wrote my first and only op-ed for Newsweek to say that no way, we're not heading for a recession, no matter what the pundits want you to believe. And guess what? We're not heading for a recession. We never had that recession. It had happened earlier with prior to June of 2023. And if you look at earnings conference calls in the last quarter, the 2 quarters, Q1 versus Q2, the number of mentions of recession collapsed from 25% to just 3%. So there was a brief moment, a brief blip where CEOs were worrying maybe about the economy and the recession, but not so much anymore. Fast forward 3 months. I think we're beyond that because we have clarity on most of the tariffs. So yeah, beer me, I was right on no recession. I'm not saying that there's never going to be a recession, but I think we dodged the bullet and people should not be fearing a nasty recession a la 2008.
No recession, AI stocks, you're crushing it, man. I'm a drink to that.
Yeah, I'm gonna crush a beer here. Hopefully. Oh, wait a minute. I don't know what this is. It's a mango hard seltzer. Yeah, that's on brand. I got nothing to say there. All right. Well, listen. This is what's on brand. We try and deliver to you only actionable insights, and we've hopefully done that today with just some interesting information on the energy crisis that's going to be plaguing AI, but then also a new innovative ETF in AOTG. So again, I encourage you to go to both of those websites, support our guests, at least do some more diligence. I'm going to be taking a closer look at John's ETF to possibly invest myself. I want to thank you, Dodd Man, for through the thunderstorms and that only plague UCF Knights fans, sticking with it and figuring out a way to keep the power on, my friend.
It's going strong now. I don't know if you can hear that, but it's going.
I can't hear anything. I'm just smell the sweetness of a mango seltzer. Yeah, say that 3 times and be serious. Anyway, we're going to be serious. We're going to be serious about being back here every Monday at 5 p.m. Eastern. So join us next week, where we'll have more guests, more investment insights, and maybe a little silliness along the way. I'm Lou Basenese.
Possibly the skinny dip.
And possibly the skinny dip, if my wife has her way. So tune in. Who knows? Thanks again.